TFSAs versus RRSP. What's the difference and how do you pick between the two? TFSAs and RRSPs both offer tax benefits to help you achieve your financial goals sooner. But which is right for you? When does it make more sense to put your money in a TFSA and when should you choose an RRSP? There are key differences between the two. It is important to identify which of these is best suited to your financial goals to make the most of your hard-earned money. In this video, I cover important considerations to help you decide whether a TFSA or an RRSP is right for you and in what circumstance. If you don't know how a TFSA or an RRSP works, I have linked videos that you should watch first and then come back to this. So let's start off with, what is your financial goal? The first question to ask yourself is, what am I saving for and when do I need the money? For short to medium term financial goals, where you need easy access to your money, such as building an emergency fund or buying a car, your TFSA is better suited. Money inside a TFSA can be withdrawn freely at any point in time with no tax consequences, making it a flexible option to access your money whenever you need it. When you take this money out, you don't lose your TFSA contribution room. You get this room back on Jan 1st of the following year. However, when you withdraw money out of your RRSP, you do have consequences. You are first taxed on this money at your marginal tax rate. Second, you lose this contribution room forever. You never get it back. So for short to medium term goals, where you need easy access to your money, the TFSA is better suited. For long-term financial goals, where you are comfortable with storing your money away for a long period, such as saving for your retirement, the RRSP is better suited. Your RRSP money is intended to provide income when you retire. It is designed so that when you take your money out, you will be earning less and fall in a lower tax rate, meaning you will pay less tax in your lifetime. This works well for its intended use, but does not help with short to medium term financial goals. The next consideration is your income level. If you earn a high income and fall in a high marginal tax rate, it is most beneficial to contribute to your RRSP. An RRSP lets you defer paying taxes, giving you money back in hand right now. For example, you had taxable income of $120K, so your combined federal and provincial marginal tax rate is 43%. You claimed a $1,000 RRSP deduction, so you would get back $434 in tax savings. You then withdraw this money when you are in a low tax rate of 20%. The tax you would pay is $201. So the net money you saved from $1,000 is $234, equating to a 23% return. I don't know of any investment that you could hold inside a TFSA that would give you this return. If you do, leave it in the comments. This is assuming you don't need this money in the near to medium term. If you need this money for some big cost in the next couple of years, then of course, pick your TFSA. If you want to be extra wise, you can invest the refund money you get back from your RRSP contribution into your TFSA or regular investment account. If you have little to no earnings and fall in a low marginal tax rate, you can put your money into a TFSA to grow your investments tax-free. There is little tax benefit to put your money into an RRSP, as you won't get big tax savings from it. You likely won't have much RRSP contribution room, as it is linked to your income. The TFSA contribution room isn't linked to your income. You get it regardless of whether you earn an income or not. When you eventually earn a high income, you can withdraw your TFSA funds and make contributions into your RRSP to enjoy the maximum tax benefits of an RRSP deduction. The final consideration is U.S. Dividend Withholding Tax. If you intend to invest in U.S. dividend stocks or ETFs, there is a clear winner to pick, the RRSP. U.S. dividends inside a TFSA have a 15% U.S. withholding tax that is deducted and paid to the U.S. government. You receive this dividend after it has been reduced by 15%. This is not the case for RRSPs. If U.S. dividends are received inside your RRSP and you complete a US W-8BN form, you do not pay any US withholding tax. So if you intend to invest in US dividend stocks, hold these inside your RRSP and not your TFSA to avoid paying any US tax. So to recap, for short to medium term financial goals where you need easy access to your money, a TFSA is better suited. For long-term financial goals where you are comfortable with putting your money away for a long period, an RRSP is better suited. If you earn a high income and don't require this money in the near term, invest it in your RRSP to maximize your return. If you earn a low income, growing your investments in a TFSA may be better suited. If you intend to invest in US dividend stocks, hold these inside your RRSP and not your TFSA to avoid paying US tax. Let me know in the comments down below if you have any questions. Thank you for watching.